Good afternoon, Steve Hunnam here from the Property Support Network. We had the Property Support Network online networking Zoom yesterday with a presentation from Chris Haley from Property Tax 360. Chris covered how Section 24 can be reduced for rental properties held in your own personal names with an optimal commercial structure. So I'll now hand over to Chris for his presentation from yesterday. You've accepted your co-host.
Yes, I have. Right. So bear with me, everyone. So it's the right one. Right. Can you see that?
We can, yes.
Excellent. Been trying to work out the difference, working between a Mac and Windows this past week. So forgive us if we get it wrong. Okay, right. So, sorry? All right, okay. Okay, I'm Chris Haley, for those who have not met yet. Section 24, for those in buy-to-let, remains an open sore for many. And many have turned to companies as a way of dealing with the problem. So today we're going to explore that in a little bit of detail, but also a little known and little understood alternative. We see lots of stuff on social media about these things, and it's an opportunity, I think, to hopefully bring some clarification to proceedings. So normally when I do that, the screen is meant to change, but it hasn't, so I'll have to go back to that way. Right, okay. So if we look at incorporation, and this first bit is dealing with those who have got properties in their own name. And according to statistics, it's still about 80% are in this position, despite all of the marketing efforts to get folk into companies. Section 162 is a part of the Taxes and Capital Gains Act of 1992, and it provides an automatic capital gain deferral from the properties into newly created shares in the investment company. Now, back in 2017 and beforehand, you could get non-statutory relief from HMRC. They stopped doing that in 2017. And I mention it because one of the guys on our team does something called dispute resolution. This is where if you get a nasty brown envelope and the revenue are querying something or challenging you or challenging us on something, that will help defend that. And we've seen at least half a dozen in January of revenue inquiries into those who have incorporated since 2017. It might be mischief making, it might be the start of something else. We just don't know, but I think it's important that people are fully aware of what's going on. But we'll stay on the positive and we'll assume that capital gain is deferred. The next issue, of course, is stamp duty land tax. And you may have heard of the Ramsey principle. Section 15 of the Finance Act 2003 deals with this particular issue. So if you can satisfy, or if the investor can satisfy HMRC on that, then there's no SDLT to pay a second time, bad enough the first time. So now the investor has a new investment company, or it might just be that they've been dealing from day one with an investment company. For those who have transferred in, they've now automatically changed their mortgage T's and C's, and mortgage lenders will want to have a chat and require the investor to remortgage, probably at an inopportune time, I would guess. Now, again, conjecture on the next point, it's our view that from April 1st last week, investment companies will pay tax on their profits, on all their profits at 25%. It's our view, or my tax team's view, that investment companies do not benefit from the trading company exemption, where the first 50,000 is taxable at 19%. We've had endless arguments about it. At the end of the day, HMRC will decide once the first set of accounts are submitted, but that's our view. Getting money out of a company is especially expensive. The first £1,000 is tax-free, but then we pay 8.75 up to about 38 grand, and then 33.75 up to 125,000, and that's in addition to corporation tax at 25%. So not cheap. And those who are promoting incorporation often compare corporation tax with the highest rate of income tax, where the investor's investing their own name. But there is this additional tax if you want money out of the company, and on the basis that we need to put food on the table and pay the bills, then I think it's a relevant point to make. Going forward, any gains from the date of incorporation will suffer tax at the corporation tax rate, which again we say is 25%. For those investors who want to leave something to their loved ones, and I know we've got asset specialists in the room, there's no business relief to an investment company, so further planning needs to be put in place. This can lead to a smart company or family investment company structure. It involves, we think, a bit of complexity and certainly a fair bit of additional cost. And we're not saying don't do it, we're just saying that everything needs to be taken into account before that decision is made. And I think too many people are going down this particular route because they're not aware of an alternative, which we'll now come on to. A registered hybrid partnership, bit of a mouthful. The first legislation regarding partnerships goes back to 1890. The Limited Liability Partnership Act of 2000 brought in a range of additional measures, and everything I'm going to mention now is within the rules. It's not being particularly clever, it's just within the rules. A registered partnership can have any number of partners, be they individuals and other companies, in fact, other partnerships. There's no restriction. It's a partnership agreement drafted at the beginning, which is basically how the individuals want the thing to work. And in practical terms, everything as it stands today continues from day one with the partnership. In other words, ownership remains the same. So if properties are owned by the individuals, that continues. And it's only when we change the ownership of something that we create what's referred to as a taxable event. So in this case, there's no issues regarding capital gains or stamp duty land tax. There's also no interference with mortgage terms and conditions. So mortgages remain exactly as they are. Property values are automatically rebased to current market value. So should there be a first-class commercial reason for needing to dispose of a property once the partnership's in place, then of course, because the capital gain's been extinguished, that property can be sold without any capital gains tax issues. Again, going to legacy, those who want to leave something for their loved ones, legacy is secured in 2 years without the need for alphabet shares and trust arrangements. Succession is dealt with almost immediately. And I can explain how that works subject to the time that we have. With registered partnerships, the tax assessment is on profit only, not on what we draw out of the partnership. And that's often misunderstood. And profits can be allocated to maximize reliefs. And we've got a little worked example to show at the end of this. But it does make quite a difference, and it certainly can deal very effectively with Section 24. In property tax, we've talked about beneficial ownership at the beginning. Beneficial interest represents the equity in the portfolio, regardless of what the portfolio is investing into. And the beneficial interest can be transferred into the partnership. So an example, let's say the investor's got £250,000 worth of equity. That is transferred by a simple letter of trust, not a deed of trust. It's a non-reportable event. And the accounting treatment is to credit the partner's capital accounts. And the partner's capital account is exactly the same as a director's loan account, withdrawals from which are not assessed for tax. The partnership can add family members in the fullness of time. And the cost of it is typically about 1/3 of the cost of incorporation. and the smart company play. Now, quite a bit there to sort of deal with, but hopefully the example will add a bit of meat to the bones. Let's look at some clients I'm currently looking after at the moment. Older members might recognise the names. Basil and Sybil have got a portfolio in their own names. The current value is about 2.5 million. It costs about 1.5 million to put together, and outstanding in mortgage at the moment is 1.75. Forgive me, but I like nice round numbers. It makes it a lot easier for me. Rental income, 160 grand a year, loan interest just over 100,000 a year. And the profit, so rental income less allowable deductions, is £130,000. And we've got all of that from their SA 302s for tax year 21-22. And the Section 24 tax credit is worth a mighty 20,400. So it's clear that Basil and Sybil have got higher rate tax problems and are not feeling terribly happy with life just at the moment. Our starting point for everybody that comes to us is we provide something we call an impact appraisal. It basically looks at how everybody stands, the impact on how their portfolio stands based on those key issues as now listed. NAV, net asset value, current value less outstanding borrowings, £750,000. That's the bit that goes on the IHT form on second death. And where young Manuel will have to pay £300,000 in IHT on we're assuming Sybil goes second. I mean, the girls always go second. So that's quite an IHT risk. The portfolio gain is standing at £1 million. So any change in ownership, any sales could give potentially a capital gains tax bill of £280,000. From their last self-assessment returns, both Basil and Sybil are paying tax, some of their tax at 40%. We got an illustration from one of the team who does incorporation. So, you know, we're not just saying that all we do is partnerships. We cover the whole range. And for incorporation and the smart company structure, the fee would be £40,000, and that doesn't include refinancing and the associated legal costs. So quite expensive. So then we look at the registered hybrid partnership. And just to refresh, there'll be no change in ownership. Basil and Sybil will continue owning those properties in their own names. Therefore, there's no risk of capital gains or SDLT. The partnership would start with 3 partners, Basil, Sybil, and the company called FT Limited. Why the third corporate partner? This to deal with succession for the children. The children couldn't be partners at the start because that would be a disposal for tax purposes. So by setting up a small trading company, making the children the majority shareholders, but where Basil and Sybil control the company through the articles and making that company a corporate partner, it means that last man standing, when Basil and Sybil have both died, then the children will be the last partners and they would automatically succeed. And as long as Basil and Sybil survive 2 years from the start date, there'll be no inheritance tax to pay. No obligation to refinance the £1.75 million worth of borrowing because mortgage T's and C's are completely unaffected. Legacy secured in 2 years because the transfer of beneficial interest, the equity, goes into that FT Limited, which is a trading company. And of course, trading companies do benefit from business relief for IHT purposes. Property values are rebased to current market value, so that £1 million gain is extinguished. And the opening balances on capital accounts will total £750,000. So withdrawals from that will not bear any tax. And we're going to allocate the profits 20% to Basil, 20% to Sybil, and 60% to FT Limited. Basil and Sybil's profit share is £26,000. The company's profit share is £78,000. So now let's have a little look at a tax estimate, and this would be how their SA 302s would look for the tax year 23-24. £26,000 their share of profit. We deduct their personal allowance of £12,570. The finance cost relief share is £6,800. gives a taxable income bill of 6,930, and at 20%, that gives them a tax bill of £1,386 each. We then look at the company. Company's profit share is £78,000, against which we can offset all of the company's share of the loan interest, £51,000. So the profit before tax is £27,000. Corporation tax at 19% will be a tax bill of £5,130. Total tax just over £7,900. That provides an overall effective rate of tax on profit of 6.08%. And that's it. I'd like to make it more complicated, but it is very, very straightforward. It's just a simple partnership. Unlike the company now, where when the investor has to refinance and mortgage lenders are demanding personal guarantees, which of course effectively erodes the veil of limited liability, the partnership does have limited liability. It's not designed just to be purely for saving tax. It is a commercial vehicle designed to support those who are entrepreneurially minded. For those investors who have already got a company or other business interests, the partnership could include those businesses as corporate partners. Why is that a good idea? Well, because those companies may invest their post-tax profits into the partnership. So instead of drawing dividends, those post-tax profits, the accounting treatment is to further credit partners' capital accounts, withdrawals from which bear no tax. And that's it. And that's us. And I think there's a Q&A later on, Steve. Is that right?
Yeah, unless you want to do it now, I'm happy to.
Yeah, I don't want to interfere with the running order, but yes, I'm happy to take questions now. If
let's do it now, then, while it's fresh in people's minds.
Can I ask a question, please, Chris?
Yeah, of course.
Hi, it's Dipti. You say you put it into the director's loan accounts, the profits between the intercompanies. So technically, you could put some money profits into the SAS company SAS and put some into the director's loan account then, which is more accessible to withdraw.
Yeah,
which you're not taxed on.
So your SAS contributions obviously reduce the burden of corporation tax.
Yeah.
What's left can then be invested into the partnership and withdrawn tax-free.
Brilliant. It's good to know. Thank you.
Hi, it's Ramesh here.
Hi.
Yes, how you doing? You're right.
I'm good, thanks. You?
Hi. Yeah, with regard to their personal estate, like main house and personal wealth.
Yeah.
This only covers all the business aspects of it, not the personal aspects.
Yeah, that's a good question. I was hoping you might raise that. This is where, if we don't impress upon the individuals that the person who is managing, doing their estate planning post-death, so we deal with everything up to the point of death, but after that, there has to be another expert involved, and that expert must have a full understanding of exactly what this partnership entails. We've seen over the last 7 years, we've done over 4,000 of these over the last 7 years. We've seen numerous examples where the will writer, for example, or the solicitor who did the conveyancing and picked up the wills as well, was blissfully unaware of the arrangements and spent endless times during, with probate and trying to organise paying inheritance tax, when of course there was no inheritance tax that needed to be taken care of. But with regards to the principal private residence and other assets, that clearly needs to be dealt with. And that's why we would look to refer to another qualified professional to do that.
And HMRC are aware of this system that's been set up and it's compliant.
Yeah, it's the Limited Liability Partnership Act 2000. Everything I've said is within the rules and regulations, and the partnership was registered with Companies House at the very beginning, and compliance is provided by the team who set the thing up. Over the last 7 years, up-to-date stats, because I was preparing for today, we've had 20 inquiries, but they were all related to items on self-assessment return and all 20 who got letters just querying stuff were people who had late filed before in the past. So it was nothing specific about the partnership itself. Again, I go back to the point that because ownership remains completely as it is, nothing changes operationally, nothing changes circumstantially. Everything remains exactly as it is. And that is, I think, a major benefit to this whole process. There's a lot of people who are selling, for example, incorporation purely as a way of saving tax. And in all my experience, one thing I know to be true, and that is that if the main outcome or intent of any planning is just to save tax, then it will be looked into. It's only a matter of time. And as I said earlier, that's already started into those who've incorporated since 2017. Again, it might be just mischief making by the tax authorities. Those inquiries, if the work has been done properly, will come to nothing, but it's still going to take up time and hassle and stress and a bit of cost to respond to HMRC. And how we respond to HMRC determines whether we close the door down firmly or we open the door wide to let them in and ask further questions. Accountants, I often ask this question, and it may come. So many of our clients have said, well, my accountants never heard of this. All my accountants is there's a problem with partnerships, and quotes a specific case that was around a few years ago. There's about 6 different ways of setting up a partnership. One firm that specializes in incorporation actually uses a partnership prior to incorporation if there's an issue of a stamp duty land tax. But the way that we do it is not that way. The partnership effectively owns nothing. It owes nothing. No debt, no assets. So if it needed to be wound up, it's just an admin exercise. Whereas now winding up a company, since the 21 Finance Act, where HMRC will restore to being the principal benefactor or beneficiary, or principal creditor, beg your pardon. Now HMRC will want to make darn sure that they've had every penny over the years that the company's been in place before they'll finally sign off. It's no longer a case of just listing at the London Gazette and waiting a few weeks and then the company's wound up. Because the partnership owns nothing and will have no debt, because the assets remain owned by the individuals, and or if they're using a company as well, because the investment company can also be a partner. This works regardless of whether the assets are buy-to-lets, serviced accommodation, furnished holiday-lets, commercial, and it works in tandem with first-class pension planning, because we can't deal with the corporation tax issue, the deductions for CT, but we can certainly make sure that the post-tax profits are yours. So it increases the return on investment quite significantly. And what I should have done in the example was illustrate what Basel and Civil were paying in tax beforehand. What they were paying, some of their tax at 40%, quite a decent chunk at it. And I suggested in the presentation that we were going to split the profits 20% to Basel, 20% to Civil, and then 40%, 60% of the company. That split is worked out on specific numbers. We've got it's taken a while, but we've now got a spreadsheet which is all cleverly computerized. I don't know how it works, but it just works. And we feed in the numbers to make sure that actually the finance cost relief, the tax credit, becomes an asset, despite all the negative situation. And I've just done a case this morning for a couple of clients, and their estimated tax bills for 23-24 are less than £500 each. And overall, their rate against profit will be less than 5%. They're still paying tax. And as a partner in a partnership, the top rate of income tax remains 45%. The top rate of capital gains tax remains 28%. The rate of IHT remains 40%. Nothing is changing. It's how it's put together, it's how it's structured that really makes the difference. And and it's just, I just think it's really very effective planning, and I think it could turn the tide for those investors who've decided that they've had enough, want out. They might just now think, well, if you know about this, let's stick it out a bit longer. And the cost of that partnership is about a third of the cost of incorporation.
Okay. Sorry, Chris, can I ask one more question, please?
Please, yeah.
In terms of, I know it's Dipti again, hi. A lot of people put their kids into the company as shareholders and stuff like that, but then that eventually has a tax burden on them because they're obviously in other jobs and things like that.
Yeah.
Is there a way to use this to sort of, because obviously they wanted to withdraw some of the money of the profits of the company. Is there a way to do that without impacting?
Well, if we go to FT Limited here, so this will be the company owned by Basil and Sybil's children. They would own the majority of the shares. I think the children in the case this morning were just 9 and 10. But mum and dad, through the Articles of Association, would control the company. Again, it's a misnomer that it's the shareholding that controls the company. It's not. It's the articles that actually say who has final say. So the company is a corporate partner for as long as it's right. We all hope our children will grow up to be the right kind of people, who will meet the right people, both professionally and socially. But there's no guarantees. The pressures on kids today are just horrific. So the alphabet shares for children gifting into trust is very, very difficult to unwind. And that situation, if a problem arose with one of the children because of someone they're dealing with, or married or in business with, then of course those assets could then be an issue for a divorce court or for a bankruptcy court. With this, the FT Limited company can be appointed a corporate partner, but it can also be removed as a corporate partner very, very simply. So mum and dad retain absolute control right up until the date of second death.
Okay.
And in
so
this
that's where the estate planning does really come into play then.
Yeah, and in this case, the profit share for the company, there's only £5,000 worth of corporation tax there. So the post-tax profits can then be drawn by or used for the children's purposes, tax-free, because it goes into the company's director's loan account, individual partners' capital accounts into the company's director's loan account.
What about children that are over 18? How does it affect that then?
Same applies. Age is relevant.
Okay.
It's all about ensuring that mum and dad, or just mum or dad, whatever the dynamics are, retain that control, and it's not lost. And I guess our concerns about the smart company structure is that, to a certain extent, there's control being given away, and it's very difficult to reverse those transactions. I'm not saying, again, it's not a good idea. We're just saying that we think a lot of people are doing it being unaware of
the risks,
all of the options. It's like pensions, how many people are fully aware? I know you've got some really great SaaS guys on the team. How many people are fully aware of exactly what you can do with a small self-administered pension scheme?
Yeah.
Very, very few. But once you know, it's pretty exciting what can be done with these things.
Yeah.
And the same thing applies to a simple partnership. In black and white, it looks, a bit boring. And I think that was the view taken by most accountants, because they think, well, there's no tax benefits here. You're still liable to tax at 45%, as I said a few moments ago. But it's knowing how to construct it. It's in the construction that really delivers the results that we're talking about. And I think overall, a tax rate, an effective tax rate of just over 6%, I think most people could live with.
Brilliant. Okay, we certainly need a one-to-one. I'll get the details off Steve if that's okay, and we can organise something in the next couple of weeks. Thank you.
Yeah, pleasure.
No, I think Ian, you asked a question in the chat. Happy for you to come up and ask.
I haven't seen the chat box. I can put my glasses on. That's quite small.
Yeah, I can. It was just something you mentioned in chatting there, and It's come up a couple of times this week, interestingly, on different chats and webinars, and so forgive me, my knowledge is fairly scant on the topic. So
Is this Ian?
Yeah.
Hi, Ian. Yes, I'm familiar with the. Yes, I think I know you've been talking to.
Right. There was I think it was a property wealth webinar that talked about FIPs and SASs and stuff. But then, as part of that, they made a statement on one of my questions to say, don't ever do this. I've got a feeling there's a mid ground, and I think you've mentioned it. There's multiple ways to set up partnerships, so it might be the devil's in the detail.
Yeah,
I'm fairly early on, and we haven't got a limited company at the moment. We're just doing things in our own name because we've got enough tax space, or I thought, to use lower rate tax with deeds of trust and things. But they were talking about at a later stage, when we're looking at incorporating, to go through a LLP or a partnership for 2 years in between personal name and company, which would avoid SDLT and corporation tax. And I noted you just briefly touched on that in your answer to one of the previous questions. So it was.
Yeah, I think from our perspective, it's that interim measure, and it's where, for example, oftentimes we see it used where, for example, say one of the two partners, husband, wife, or whatever the relationship happens to be, has a full-time job as well.
Yeah.
And that's very difficult to satisfy Schedule 15 of the Finance Act 03 that deals with the number of hours you've got to put into the property business. It has to be a proper property business, excuse me. So setting up a limited liability partnership basically says, right, well, that's now confirming this is a proper business. And as long as you wait a couple of years, there's no actual fixed term. It's very much at HMRC discretion. I think what we found from experience is that after 2 or 3 years, they tend not to be overly surprised when full incorporation then takes place. Our view is we just don't see the point in full incorporation, because aside from it providing full tax relief on all the relevant loan interest, it doesn't achieve much else. So we would be saying, if you were having a chat to us, well, keep doing it in your own name. When you get past, say, 4 or 5, and it's a full-time occupation, then look at setting up the partnership as described, because it will give you all the things that you want, and the end result is as described for Basil and Sybil. That we've seen costs of setting up the partnership and then moving to incorporation. It adds another 7 or 8 grand to the whole process, but you're still left with a company that will pay 25% tax on profits. Costs typically 33.75 to get money out. If the mortgage lenders still insist on directors' personal guarantees, still no limited liability cover. And no business relief. So you've still got to do the smart company, which again adds to the cost. So personally, I wouldn't do that, but I know many people are. Stone silence.
Sorry, I realised I went back on mute while you were talking. Thank you very much for that.
Pleasure.
Has that helped at all, Ian? Or
Yeah, sure has. It's all really good stuff, isn't it? So just taking it in and knowing when the right time is to play different bits. So yeah, thank you for that. That's really helpful.
I think without knowing too much about it, I would carry on as you are.
Yeah,
you're going to get better deals borrowing personally. I think the moment you find yourself straying potentially into higher rates, that's when that would prompt you into taking action. We've heard rumours about Section 24, which at the moment is a 20% tax credit, potentially being cut to a 10% tax credit.
Right, okay.
We're in that space now the next 2 years where literally anything can happen. And who would have predicted the Chancellor abolishing the lifetime allowance and pensions last month? I mean, I never saw that one coming. For years, they've been talking, for decades, they've been talking about restricting tax refund pensions, removing the tax-free lump sum, but to abolish the lifetime allowance. I mean, the cynic in me says, well, that's it's an election sort of positioning move. But I mean, Labour have already said if they win next year, they're going to restore it. So what happens in the meantime? That people make use of this no lifetime allowance and then suddenly find they're screwed 18 months from now.
Although usually they don't back play things, do they? So if you've been in a period where you've got something for that period and time, they don't usually undo
They
it.
might allow some form of protection. That was always the case when the LT first came in back in the day. But it's a risk. It makes it very difficult to plan long term. And I think there's a phrase that I would suggest that I think your accountants would be familiar with. GAP, Generally Accepted Accounting Principles. It's the foundation on which the UK accounting profession works, and a partnership is firmly in that space. As for abuse, the only abuse that has been reported, and it's where accountants can get a bit uptight about it, is where if the partnership was the trading vehicle, which is not in our example, but if it was the trading vehicle and it had a corporate partner and the partners chose to send profits down into the company to extract because there was a better tax rate at the time, then clearly the motivation for that is to save tax, and that's what the revenue would stomp on. That's clearly not what we're talking about here. But I think it's what most accountants understand. We're aware of, there's probably about half a dozen accountants that are fully understanding this, which is a pretty small number. Any other questions?
You've stumped everybody.
Hold on, me. I'll have a question. So with somebody, obviously I'm a estate planner, so basically we're looking at the business side of things here, and if we're looking at personal side of things, if we were looking at care home fees, bankruptcy, sideways disinheritance, or divorce of beneficiaries, that sort of stuff, would any of this sort of protect the asset and the legacy at all, or would it still need to put that in place?
It's a good question. I think that those things that you've mentioned, take care fees, for example, it was something I was involved with 20 odd years ago, and I got out of that because I felt that nothing was going to change. There was the Royal Commission 1997, and it set out the challenges, and here we are 28 years later, 26 years later, nothing's really changed. It's got worse, if anything. And I think, obviously you're experiencing this, so deliberate deprivation, you're aware of the situation. If the care home is charging significantly more than tariff rate, then whether you've got assets protected by some kind of trust is largely irrelevant. Someone's got to pay the difference. So that has no bearing. This is not meant to be any kind of tax or circumstantial avoidance exercise. If it was, it would be, the revenue would take a different view on it. This is a commercial structure to support those people in business, and we've sort of designed it with landlords, with property investors in mind. This particular example, to build a structure that will support their efforts and ensure that there'll be longevity, that their legacy will be secured, and that they will be adequately rewarded for all their endeavours. That's really what this is about. We would turn to experts like yourself to deal with those issues you've just mentioned. But I think you'd accept that if the will writer, if the estate planner was unaware of the implications regarding the partnership, that could create an awful lot of problems on second death.
Well, it would be down to the executors, obviously, to adhere to what's in place, because what we would do, as will writers or estate planners, we would put into place in the will and the paperwork to say that there is this platform that's put in place, and to follow the tax liabilities and tax requirements according to this platform. So that's how it would be sort of positioned in regard to instructing the executors to do that, because that's their responsibility as executors to produce a report for HMRC.
Yeah.
So yeah, obviously the will writer, if they're not aware of it and somebody puts this in place and they've not put it in the will, then obviously that's something that they need to address. Or if the executors are aware of it, and then they could say, well, here's the will, these are the wishes of letter of wishes that the client can do, can say, I've set up this platform, and the executors are requested to sort of do this particular procedure, follow this format to get to the solution of paying the right amount of tax to HMRC according to the allowances that are allowed through this process.
Yeah, we see it as whereby that, you know, we need to work in hand with the estate planner. There's no sort of competition or anything here. I think
no, of course not.
It's a team. It's, you know, it's we say for so long, you know, that if the property investor has got, you know, mortgage broker, lawyer, accountant, tax planner, will writer, estate planner, all working together for the good of the client, then, you know, that's going to be the best outcome. It so rarely happens, I think, as we both know, but it's certainly our goal to try and make that possible.
No, this is why PSN is in this sort of boat, because we promote this sort of philosophy of working to each other. In our presentations, we have architects, lawyers, solicitors, people that are in the industry, and particular individuals that's using those facilities within the network. They know that these people know each other, and they'll communicate with each other as well, and it works better for the client for using people within the network.
Yeah, and that's what we're all about.
Definitely.
Yeah, it's one of the reasons why I approached Steve.
I think this is really good. It would benefit a lot of people within the network, I think, yeah, if it's suited what their requirements.
I think the point I made to Steve when he and I first met a little while ago was that it's I think we see ourselves as more of an educational play. We're not, we've got a lot of work. We're not sort of, I hate that phrase, touting for work. It's genuinely, supporting the network, providing second opinion, which we never charge for, answering those questions which you may find difficult to get answered by accountants, for example. I'm going to down on accountants. I just know that their focus really has been on compliance for a number of years now, largely due to insurance restrictions. The PI insurance industry had a real go at their professional, the accountancy profession in 2015. That paid out millions because of the accountants' direct and indirect association with the various tax schemes that we still read about today. And they were offered the chance of buying more expensive insurance with a huge excess if they want to continue being involved in non-accountancy stuff. But the vast majority thought, no, we'll do what we're good at. But I think perception is everything, and I think the perception is that if our accountant doesn't mention something, then we're doing the best that we can be doing. Because that's just not the case, because those who are using companies, especially those who've got more than one company now, will really start to feel the pinch through the associated companies rule, and there's not enough being said about that. But we're just a small organization. We in the current format under this particular banner, we've only been around since December. But my team, who are keeping a lot covered at the end of the corridor for reasons which would be obvious if you met them, we've got hundreds of years experience in this area, and we just want to make it available to the network and support you as best we can.
That's great. Thank you, Chris.
Pleasure. Thank you for the opportunity.
No, it'd be interesting to see what, obviously, once we share the sort of recording, it'd be interesting to see what other things come out of the woodwork from people that watch the recording on the event today.
Yeah.
Yeah, no, thank you very much for taking the time out and doing the prep. Any other questions? Or have we questioned Chris enough?
Yeah.
No, I'm just going to listen to it again.
You lie
Yeah.
down.
Yeah, I'm sure Chris would be happy to follow up if anybody's got any questions.
Absolutely. Yeah, I mean, this
Thanks,
is not a sort of one-off. Don't worry, I'm not going to sort of plague your lives, but I think I'm on the WhatsApp group, and I think you've got my details. Happy to answer questions. As I said, second opinions without any sort of requirements or obligations on your part. It's supporting the network as everybody else who's in the professionals is wanting to do. You know, I'm no different.
Good fit for PSN.
Definitely.
Definitely.
Cool.
Hopefully, it's nice to be here.
Yeah, no, it's good to.
I would love to come to the sort of. I'm up in Newcastle, so I'm miles away. So when Steve said, you know, we're going to set up on the northeast, I'm thinking because the northeast needs this network. There are a couple of property collaborations that don't operate the same way that you guys do, and I think there's a huge opportunity up here in my neck of the woods. But I'm going to get the old bus pass out, or train pass, and head south at some point.
Come in a bus or a train. That way you can stop for the curry as well and not worry about anything.
Well,
We'll always have a curry afterwards.
I've heard about this. I've heard this is well worth checking out. So yes, I shall do
That's
it.
an incentive for you, Chris.
Absolutely, yes. Yeah, I haven't had a good curry for a long time.
I
Well,
hope-
that's one of the reasons why I like the PSN, because we all work with each other. We're not fighting against each other.
Yeah.
And whether you're people like you who actually help people out, or the landlords or the investors or whoever, it's us working and helping each other out, and that's one of the best points about this group.
I would say it's a USP.
It
It's unusual, but it's especially at the moment. You know, I think it's never been more important. So I think it's excellent, and I think Steve.
So thank you, Steve, for continuing.
Yeah.
Not easy, but I'm really looking forward to sort of what the future holds, and it's good for me personally as well. So at least it gets me out there, and people start to know about me, and obviously with Alistair, the likes of Alistair and people joining, there's like sort of PSN now. I think it's going to go from strength to strength, which is good. Yeah.
I'm going to have to duck out, I'm afraid. I've got a personal thing I've got to attend to. So please forgive me for leaving early. But I am to say,
I'll stop the recording now as well.
Yes, so I don't tell you why I'm leaving. But yes, I'm